Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Joann Nevruzi and Joann Spadigam. Okay, Happy New Year, Bondcasters. We've only had not even a full 3 trading days of the new year, and it already feels like a lifetime. But I suppose that's what we're here for, to digest and make sense of the market moves that we've had. Jan, I think I'll start with you because I think it's probably fair to say that we've had the most kind of data and perhaps information out of the US over the last couple of days. We entered this year in the US with rates or yields at relatively low levels. We obviously had that kind of monster rally in everything at the end of 2023. What's your, I guess, near-term view on the direction of travel of rates and the curve?
And, after we had our year ahead, like you pointed out, we realized a lot of our targets for particular longer yields. So think 10 years, 30 years, pretty much by the beginning of the year because of that monster rally, as you described it. And that was and just to kind of step back before I discuss what I expect for the next couple of weeks or a month or so. I think what was really surprising was not so much what happened in the shorter dated yields, right, where the curve is really influenced by what the monetary policy decisions are. And post the last Fed meeting of the year, the market's got a confirmation that the next move is going to be a cut, that the Fed is now discussing it, even though they kind of are trying to play a little bit of coy, saying that we might keep rates high. I think the next step is pretty clear that it will be a cut, and all of these cuts have started leaking all the way through January and March, and I will come back to that in a second. But the front end has shown a lot of the pricing for how quickly the Fed can come in, pretty much as soon as March at this stage. So that point makes sense to us. And once you kind of open these the proverbial floodgates, it is understandable why you would rally so much, because the tail risk of a hike is now off the table. And COVID should have taught us to never say things like it can't happen, because a lot of things have happened in markets that we thought wouldn't. But I think at this point it's pretty safe to say that the tail risk of a hike is being clipped. So it's just a matter of how much we rally. What was very surprising was what happened with longer dated treasuries, where it's not, of course, they have a beta to shorter dated and the overnight interest rate and shorter dated yields, but it's not, one for one relationship. So the curve barely steepened. If actually, it didn't really steepen at all when you account for carry and roll down. It didn't steepen at all post this massive rally, which is not what we would have expected. We would have expected the long end to remain a little bit higher, and that puts us at odds going forward. What we expect to see in interest rates with respect to duration and curve, right? I was just looking at our before I came here, kind of like how the trades that we had in our mind that would perform well into the year and had in our year ahead have done so far, and there's only one thing that stands out is the performance of the curve. The duration view has worked out very, very well. The short volatility view has worked out very well. Despite the starting level was so high that despite what optically looks like high intraday volatility, it's still performing well because overall levels of implied volatility have come down. You kind of see like this front end capped upside yield duration longs have performed well, and the curve is pretty much flat to negative. As what we look at is two stands. I don't want to get too specific into particulars of the trade for the sake of the podcast, but that hasn't steepened. So for duration, I think in the near term, I'm starting to be a little bit more cautious, turning a little bit more neutral. Still, officially, our medium term view is to be long rates. We see upside, but it's if you're long 2-year yields, 2-year treasury notes, you just lose about 10 basis points a month on the financing costs and the roll. It's very substantial. You need to see a lot of volatility for that to happen, and we're not going to take off any trades before the Friday's NFP numbers, which listeners will have already seen because it's a high vol event. But after that, we could consider scaling out of those and kind of remain only steepeners, which are a little bit more, I should say, less punitive when it comes to holding holding them, and still we think can perform even in a low volatility environment where you start seeing the long end, for example, weakening uh, on kind of like lack of momentum. So duration, I'm turning a little bit more neutral. Again, like I said, we could have one leg of a rally again post Friday, and I will have to reevaluate this as we get the non-farm payrolls. And curves that still think they can steepen. We're looking at 2 stands and 530s. I think they can both have room to go. And we think the next leg of the outperformance in front end rates is not going to come from the markets pricing in cuts sooner, but what I think it will come from is markets pricing in cuts in larger increments. So you go from 25 to 50, for example, in May, and so on for the next meetings where the Fed brings to us a better neutral level faster. I think that's what's kind of differentiating us at this point, because you look at forwards pricing, we see the Fed stopping at 3%. Forwards market have it at like 3.3. I mean, there's not much upside. It's within like a margin of error anyway. So I'm not too comfortable saying that's a must buy right now. But if you kind of look at what's within 1 year, it's still fairly high.
Yeah, you mentioned obviously the data tomorrow. As I said, we're recording this on Thursday, which especially this week feels like a tricky time given that we have NFPs and euro area inflation tomorrow, the kind of key prints of the week, which of course will come onto the European side a little bit later. But just so I would remind listeners of that to put a bit of context around the discussion that we're having. One thing that we have had, though, by the time we recorded this is the FOMC minutes. We always think of the minutes as perhaps being somewhat stale, just given that, they're released long after the event. And often we've had, new information, we've had updated Fed speak anyway. But there was a lot of attention on these minutes, I think in part because there had been some pushback from Fed speakers against the dovish market reaction of the December meeting. That the market, well, it was already in kind of dovish mode, but it certainly helped to feed the sort of buy everything or buy duration rally that we were seeing at the end of the year. Did you have any key takeaways from Fed minutes, either around that or anything else?
Yeah, so the word that we would use yesterday to describe the minutes was they seemed pretty sanguine to us, right? Like there wasn't too much new information in terms of rate policy. It looked like most participants agreed that that rates have reached a sufficiently restrictive level, and they intend to hold on. The next move could be a cut. They see the risks to inflation and unemployment a lot more balanced. They see the kind of like upsides risk to inflation as having significantly diminished. Of course, there's the usual boilerplate of we have to remain in restrictive levels until we see, progress that they deem is kind of like permanent. So not much on that side. And that's kind of what Powell said. Even though you have the occasional, odd FOMC official come out in the news and say we could hike more and so on and so forth, that's not going to happen. And those are just kind of almost feel like futile attempts at this point. So the minutes from a rate perspective didn't give us all that much new. The markets took it more or less kind of how we did. It slightly reminds, it has like a bullish tint to it because it just reminds you that, no more rate hikes are coming. They'll be cutting. And the question is when. And they should be talking more and more about that in the coming months. I thought what was very interesting from the minutes, well, very interesting for me, and I hope for most listeners if they're this far into the podcast, was a discussion around quantitative tightening and balance sheet policies. So what we got a little bit more detail this time was several participants, as was pointed out in the minutes. And in FOMC lingo, several usually stands for 4 to 5. So think like 4 to 5 people brought an idea that there has been a big drop in the Fed's overnight RRP facility, and that the current statement for balance sheet rundown, as you know, the Fed is letting treasuries and mortgage-backed securities mature from their portfolio to the extent of, well, effectively about 80 billion a month combined. So they're allowing those to mature, but the policy statement points that at some point they will have to start tapering that process, right? So go from the official limit is 95, so between the treasuries and MBS, 16 treasuries and 35 in MBS. But for reasons I'm not going to get into now, MBS effectively is closer to 20 a month. So what happens is they're going to announce the start of a taper at some point, supposed to bring that from like 95 to 60 to 30 to 0, let's just say over a 3-month period, something like that. The minutes mentioned that they should start looking at factors and technical factors that would necessitate such an announcement to markets. So just like they had the infamous talking about tapering QE, now they're talking about, or they want to do that about stopping QT. So that made us reevaluate our QT call. We expected the balance sheet rundown to continue throughout next year and start tapering in Q4. I think our kind of like a base case now is for balance sheet tapering to start in June. That's always a risk we pointed out the year ahead too, and has impacted markets in the way we think. So treasuries would perform well in that case. Balance sheet pressures would ease from futures markets. So we would think at the June meeting, we're going to get an announcement where the Fed says we will begin the process of tapering off from the balance sheet normalization, and from June to like say September, that process will stop. So markets have kind of reflected that, and we'll have a lot more on this in the coming weeks as we hear more from FOMC officials. But expect the next meeting minutes to show some of these technical factors that they discussed, such as some money market spreads and developments in repo funding markets. But let's stop here with the Fed. There's certainly a lot to digest in that. I love that money market plumbing stuff, so I can ramble on for quite some time. But I'm going to stop now and switch to the UK. So we.
I feel like if you're worried that our listeners aren't interested in QT, then getting into the weeds of money market plumbing might lose them even further.
Yeah, exactly. Just if you want a long form of this, just reach out and I'll bore you to this. But let's switch to the UK, and similar to the US, we did have quite the sell-off to start the year and actually end the year. What are some of the factors that are driving these this weakness in gilts, especially on a cross-market basis?
Yeah, I guess broadly speaking, I think what we're seeing now is a reversal of the two factors that were helping drive gilts across the curve a lot lower in yield at the end of 2023. And those two factors that we talked about a lot at the end of last year were the fact that this kind of dovish shift in bank rate expectations had gone much too far too quickly, and we're seeing that those expectations being tempered a little bit, and secondly that this complacency around supply, which I thought that the market had at the back end of 2023, is also starting to dissipate a little bit. On the first point, when it comes to bank rate expectations, I mean, we haven't had a huge amount of new news so far this week when it comes to the UK. There's been lots more about the US data. We've had a lot of labour market data already in the US. We'll get more tomorrow, as we've mentioned. There's been a bit more euro area data, and we're obviously looking forward to the euro area inflation print tomorrow. But there hasn't been a lot of new news in the UK front. But what we have learned, I guess, has pushed back slightly against this very dovish narrative. We've had upward revisions to PMIs, some of which are no longer in contractionary territory. Within that, we're also seeing an uptick in the price indices within that PMI data, which I think is probably throws a little bit of cold water on this idea that the Bank of England could be cutting particularly aggressively, particularly early. And the other piece of data that I'm interested in is the Bank of England's decision maker panel survey, which, although that showed broad-based inflation expectations over the 1-year horizon coming down, actually when you look at the detail, wage inflation or wage expectations over the next year ticked up, and arguably those wage expectations have, if you look at the charts over the last couple of months, have bottomed out at levels which are still much too high for comfort, I think, for the Bank of England. So we've long been of the view that although inflation data in general is starting to look more favourable, and that will be very comforting for the Bank of England, and certainly the print in December will, make it very difficult for the Bank of England to be as hawkish as they were being at the back end of last year through 2024. But I still think market pricing is a little aggressive in that the Bank of England will still want to see more evidence that wage inflation is coming down, and data like today's decision maker panel survey won't be very comforting to them, and I think, like I say, pours a bit of cold water on this idea that they will be cutting particularly early. I think, when you look at some parts of the market, maybe it shares our concerns around the wage inflation outlook, and particularly here, I suppose I'm talking about inflation. When we look at front-end pricing for RPI, for example, whether you just look at the near-term fixings or you look at the kind of one year or short-end forwards, we haven't seen the same kind of repricing in the inflation market as you have seen in bank rate expectations and in gilt yields. Now, perhaps that, and particularly you've seen an outperformance of the RPI really across the curve in the UK versus the euro area in the US. And I think perhaps that does reflect some concerns that, wage inflation and stickier and more persistent core inflation will keep the Bank of England on hold perhaps for a little bit longer. But like I say, there's kind of a juxtaposition, if you like, between what we're seeing being priced in inflation markets versus what we're seeing being priced in bank rate expectations. And I think although what the market's pricing in for inflation looks far too high versus our projections, I think we'll see a bigger correction on the bank rate side versus the inflation side. Secondly, on this idea about complacency around supply, I think I probably spoke on this podcast at the back end of last year that it felt like markets had become so obsessed with the scope and timing of the global monetary policy easing cycle that they'd almost completely forgotten any supply-related concerns. Well, I think the beginning of 2024 has been a bit of a wake-up call when it comes to that. We've obviously had a very heavy pipeline of issuance so far. Regular listeners will know that, our central scenario is that for all that 2023 felt heavy for supply, 2024 is probably going to feel at least as heavy. And, for all that we were concerned about the market's ability to digest this supply when yields were at, 10-year yields are at, say, 4.5%, it becomes much harder to see that being easily digested when yields are, at least kind of 60 basis points lower than that. And I think that's been weighing on yields. I expect that to continue to weigh. I think the steepening that we've seen at the long end is probably the right move, especially given the extent of long end supply that we have in the UK. This month alone, we have a syndication and a BOE QT auction, but through the next 14 supply events, 10 of them are longer than 10-year. So there's a big skew towards the long end, despite the fact that the BOE have kind of marginally shifted their QT operations towards the shorter end of the curve. That wasn't our base case. We were kind of caught off guard by that, as I think a lot of people were. But actually, that doesn't really offset the big increase in DMO issuance at the long end of the curve. And I think that will continue to weigh on the outright level of yields, but probably the curve shape for the next couple of weeks.
And looking at supply while we're at it and talking about the impact on yields, it's not going to be long before we kind of get not going to be long before we get the long end conventional syndication from DMO. Can you talk us a little bit through that?
Yeah, I guess that's the next kind of major supply event that the market is focused on. We know that it will be the week of the 22nd, most likely on the Tuesday of that week. Unlike the past few syndication events, it doesn't clash with any major data. So I expect it to be on the Tuesday as normal. It's kind of baseline assumption right now is that we get a new April 2055. So we know that it will be a 30-year bond, a new 30-year. But unlike previous instances of new bonds, I guess, there's no kind of obvious maturity gap at that part of the curve. But I think 55-year versus something slightly shorter like a 54 is A, where there's marginally more demand, but B, also it gives the DMO the opportunity to kind of build that up to benchmark size before it becomes a benchmark 30-year. If we get an early part of the year 54, then there's not at all long before that will replace the 53s as the 30-year benchmark. In terms of size, I think it will be on the smaller side. That will help it to be absorbed by the market. There's not a huge amount left in the overall syndication bucket for this fiscal year. There's only 4 billion and a small proportion still in the unallocated pot that could be tapped into. But the DMO have been clear previously that they would kind of only tap into that if demand conditions would necessitate. And, as I said earlier, I'm still a little bit wary about demand conditions, particularly at the long end of the curve where there's plenty of supply still. And so I'm not sure that they will necessitate really a big dip into that unallocated bucket. So 4 to 5 billion in terms of size, but probably the lower end of that range rather than anything bigger. And I think that will have to come with a relatively decent new issue premium still in order to be absorbed. If that's something in the region of 3.5 basis points, I think that would be a sufficient concession on a small enough sized issuance for it to be absorbed. But like I say, generally remain pretty wary around the market's ability to digest all the long end supply that's coming. I mean, obviously we had the first test of that demand today with the 38s auction, the first auction of the year, which actually compared to the auction stats that we were seeing at the end of last year, seemed like it was pretty well received, but that didn't come out without a concession into the auction, and B, cross-market underperformance of gilts in the morning beforehand, given those stronger than expected and upward revisions to the PMIs. Anyway, that's enough on the UK. I'm sure we'll have plenty to talk about in the next couple of weeks when the data calendar kicks off a little bit more and we get hear a little bit more from Bank of England speakers, etc., etc. So let's switch over to the euro area. Joanne, the focus this week, I think, has really been all about the inflation data. Like I say, we get the euro area print tomorrow, after we're recording this, but probably before it's published. So we don't have the luxury of seeing that, but we have, of course, seen a couple of regional prints today. How are you thinking about tomorrow, but perhaps more broadly speaking, how are you thinking about inflation over the next couple of months in the euro area?
With European inflation, it was broadly expected that the inflation print for this month would be higher than the November print, which was at 2.3%. So markets generally have been expecting this uptick in inflation that we will likely see, really driven by base effects in Germany and energy subsidies there last year. So I think for Germany, even though we did see a softer than expected print for the overall German picture, I don't think it really shifts the narrative too much in terms of overall inflation, how we see those numbers moving forward into the rest of the year. For February, we do expect that inflation will once again move lower, so sub 2.5%, ahead of the ECB meeting in March. So overall, I think this base effect was expected and I think shouldn't really persist into next month's figure. Overall, I think for inflation, similar to what we said last year, we do see the ECB's inflation forecasts from last year as being fairly stale, given that it didn't really account for the reduction and softer than expected print in November. So inflation overall, we do expect to come down in the ECB's revised forecast coming through in March. And I do think overall we do expect inflation to continue to move to target, albeit slowly through the rest of this year.
Following the rally that we had into the end of the year, I think I've mentioned that about 50 million times already on this podcast. Obviously, the euro area participated in that fully as well. And following an inflation print that although it's a slight tick up on last month, we expect it to come in lower than expected. What do you think is the direction of travel for rates, or how's your view on duration, I suppose, evolving?
The market's obviously been paying very close attention to central banks, to data, really trying to figure out when central banks will start cutting rates. And really the focus over the end of last year really was on the rate cutting cycle, and short-term rates and long-term rates have moved lower, really driven by the central banking narrative. I think in terms of where we see markets over the next couple of weeks, I think there's obviously over the end of last year, there was a lot of talk about when the retracement will come, because everyone or lots of people did think that the shift we got in the front end and in the long end was actually a bit too fast and a bit too soon. So there's a lot of questions about when this retracement will happen and what will really drive that. To me, the question is in terms of front end rates is that we do still expect only 100 basis points in cuts stemming from the ECB. Our off consensus March rate cut narrative seems to be much more consensus in the market. Around a 50% chance of a cut is being priced into March and a full cut by April. But I think there is this question about how much central banks can cut over this year, and specifically in the euro area, what will drive them to cut as much as markets are pricing in. We've obviously seen a growth picture that was fairly stagnant over the end of last year, but we do actually expect growth to pick up this year, given that inflation is coming down and real incomes really are positively being impacted by this. So to us, the growth picture for Europe is not necessarily a large recession that would mean that the ECB would have to react and cut rates by as much as the market is pricing in. So I think the mispricing is perhaps in how much is being priced in for European markets this year versus our 100 basis points forecast, because we don't really see a reason for the ECB to react as fast, given that growth will be fairly supportive. In terms of long-term rates, I mean, I think for me, I echo lots of Jan's kind of concerns with how far we've got so quickly in long-term rates. To me, the most obvious way or the most simplest way to think about long-term rates is as a function of short-term rates, but also term premium, for example. So I do think that where long-term rates do land should, at least in the long term, be supported by where we expect terminal rates to be in the cycle. So to me, even though a short-term overreaction or move below terminal is possible for long-term rates, at some point markets need to reassess where long-term rates will be and what they expect in terms of term premia, and investors, similarly to what you said, Imogen, will demand something more to be able to absorb the amount of supply we have coming through. So I think January really offers a good point in terms of reassessing where rates are. There's a lot of questions about supply and how that will impact it. And I mean, I think given that the central banking picture is fairly well priced in Europe, supply could possibly come as one of the factors that could lead to a bit more of a bearish pressure, at least at the back end of rates.
I guess picking up on supply in a little bit more detail, we obviously kind of over the turn of the year get a lot of supply announcements from European governments and treasuries, which necessitates a little bit of an update of our overall supply numbers as well. What's the kind of high level takeaways from what we know about European funding plans for 2024?
Our updated number for 2024 supply is now 1.23 trillion for 2024, up from 1.17 trillion at the end of last year. And I think that's been driven by a couple of things. So some of the funding plans have put in a higher financing requirement than we had expected. For Germany, there's obviously a lot of uncertainty around what the deficit will look like for next year, what funding will look like for next year, given the constitutional court ruling around off-budget balance sheet expenditure. So there's a lot of uncertainty on that, and I think our expectations were tempered downwards because of it. But it seems like the German funding for next year will be higher than we initially expected, and similarly in Italy. But I think what's important to note specifically for Italy as well is that one of the things that will influence how much is supplied within that 340 to 360 billion range that they've given us is retail supply, as well as NGEU loans and how they plan to use those. Last year we obviously saw a very heavy and very, I suppose, positive year in terms of retail issuance in Italy, and we do think there's enough in the household sector for Italy to once again come in and tap that market. So that will again put downwards pressure on the actual call on the capital market for medium and long-term supply. And similarly, I think in terms of NGEU funding, if they are able to use and tap into this, again, that will put downward pressure on what actually Italy needs to get from the market. So also giving us a fairly large number and a big range, I think that there are ways to reduce the amount of money Italy is asking for from the market as well. It's interesting as well that both Portugal and Belgium, who again were big retail issuers, are seeing a smaller retail supply. And I think for the smaller issuers is obviously this trade-off between using treasury bills versus retail supply and trying to balance those two things into next year. Versus Italy, of course, has a larger market overall for both of those things as well. So overall, I think the picture is very little changed for supply for 2024. We still expect it to be a fairly big year in terms of supply, very similar in terms of gross supply for 23 versus 24. And of course, now the ECB has confirmed that that ECB QT will take place both in the form of APP QT as well as PEP QT into next year. So that does add to supply pressures as well in the European side of things.
Great. Lots to look forward to on the QT and supply side front then, which I'm sure is something we'll return to many times on this podcast over the next weeks, months, years, maybe even. Who knows? Okay, guys, thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.